Hello, folks. Thank you so much for joining us today. My name is Marcia. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And the presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during this event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our guest today. Chris Deneff is COO of Grassland Capital and has had the opportunity to merge his education experience with complex compliance regulations, and most importantly, his passion for helping clients achieve their financial goals by adhering to only the highest standards of client service. Chris began his financial career at RSM US LLP, a top-tier accounting firm, where he worked in the real estate consulting group, providing lease analysis and consultation, and then in the private client services taxation group with ultra-high net worth individuals and families. From there, he formed MJ Solutions, a private consulting firm that provided custom business operations plans to over 50 business entities. With his unique educational and professional background, Chris brings a modern and fresh approach to wealth management and investing that is steeped in a solid foundation of expertise with due diligence, data analysis, and contract compliance in a variety of highly regulated industries. As a result, Chris is able to seamlessly navigate clients through financial regulations, tax issues, and more, with an emphasis on building long-term relationships through transparency and trust. And I know that we have a really fun, I think, informational presentation today. And I'm going to go ahead and turn over the time to you, Chris.
Perfect. Thank you, Marche. And as a brief introduction, the topic of this webinar today is a little bit about business owners and investing, but also about business owners and their businesses and how it's not only a reflection of themselves, but helping them drive a plan for the future and understanding where their current situation today puts them in a position for planning with tomorrow. And so that being said, Marche and I have had the privilege of doing these a few times. So what we'd like to do is make this a little bit more of a informal discussion. So we're going to have a chat about this topic, but also anybody in the audience that would like to chime in with questions, feel free to put something in the chat regardless of where we are in the presentation, and we'll stop, we'll answer the questions as need be and try to go forward. That being said, what we'd like to do is start today's webinar off with a poll. And for those of you that are in the audience, one of the interesting things that's often not talked about as much with business owners is having an exit strategy. And so what I mean by that is, if you invest in the stock market or in real estate, or if you have some type of investment, a lot of times you want to ask yourself, when is a good opportunity for me to leave? What does that look like? And so if you have a business, I'd inquire with you to maybe start thinking about, what does that exit strategy look like? Now, if you have an exit strategy, I'd like you to answer one of the first 3 bullets. Either you'd like to sell your business or you have a plan to sell your business to an outside investor, either through some type of business marketing or a private equity firm. You'd like to have your employees take over, either somebody in leadership that has a plan to sell the business. You can sell them to them on installments. You're going to do some type of ESOP, employee stock ownership plan, where you turn it over to all your employees. You have a familial succession plan in place. Either you have some children or grandchildren, or a family member that's planning on taking over your business. Or in this case, you don't have an exit strategy. It's not something that you've really thought of at this juncture. Either your business is too new, or you've been so busy that you haven't had that opportunity to think about what that exit looks like. And so with that, we'd like to just gather a little bit of intelligence here based off of that, and we'll run with that going forward.
All right. And so if you are able to put the answer in the poll right now, that'd be great. If you don't see the poll, if you can just put your answer in the chat, we'll just take kind of an informal look at what our audience is saying. All right, so it looks like we have kind of a mix of answers. Probably about half have said I don't have an exit strategy. Maybe about a third of people are saying I'd like to sell my business to an outside investor. And then maybe, a little less than a fourth have said I have a familial succession plan in place. It doesn't look like very many people are saying I'd like to have my employees take over at this point here.
Gotcha. Well, before we move on to the next couple of slides, let's spend some time just going over each of those 4 bullet points and what they mean and why they're important. So if you're selling your business to an outside investor, oftentimes what that means is you have a business that has a little bit more of a plug and play approach with management. So if you are at a juncture where you're not a key man in your business, you're not the rainmaker, and you're able to take your business and treat it like an entity where you can do a thorough financial analysis, much like you would do that on a company that's trading publicly. Those companies, you can plug and play executives and key management people into place. And as an investor, you can expect relatively similar returns based on the cash flow of that business. And so if you're in that situation, the opportunity to sell to an outside investor is often a great play, because you stepping away, you're basically exchanging your shares for cash based off of those future earnings. And so it's a great, clean, and simple exit that you can use, and you can play off of different people, because in many instances, you can shop around. You may like one person's plan for your business or one firm's plan for your business better than another. And by having that ability to step away from the business in a clean exit, oftentimes you can capitalize on the maximum return based off of that outside investor. The second option, having your employees take over, is a boutique. It's a boutique mindset. You may have somebody that's been running the business with you or for you for a number of years that you'd like to sell it to. In the same juncture, you may be in a position where you can actually sell your business to a employee stock ownership plan, which is a government-run entity, much like other retirement programs. So if you have any questions about that, I would suggest you talk to your tax advisor. Those are some unique strategies that you can do to defer tax on those sales. But it's also a great way to leave something to your employees if you feel like they've been instrumental in building your company. The third one, which is often the greatest benefit to family, would be that familial succession plan. And so oftentimes what that will do is you're actually either leaving the business to your family directly. You can do that with a number of structures that might reduce your income taxes or your estate tax liabilities. But it's a great step up for that family that's taking over. The question would be is, are they qualified? Do they have the same vested interests as you? And is this something that's more of a long-term plan? And oftentimes what does happen with family is, are your goals aligned? If you've got a 5-year plan, are your goals going to be aligned in 5 years when this hypothetical transition takes place? And then the last one would be is, I don't have an exit strategy, right? If you don't have an exit strategy, I would inquire about not only why, but also what is the ideal maybe retirement or exit look like for you? Is this a business that's more of a lifestyle and such, there really isn't much of an exit strategy? Or is this a business where, you really just don't know where it's going to be in a further time out? And I would just encourage you to think about, putting some rough plan together. And an exit strategy doesn't have to be finalized. It doesn't have to be finite, but it should be something that you just keep in the back of your mind. And coming from not only personal experience, but also experience with clients and friends and family, oftentimes an exit strategy can be something as simple as, we're going to run this business until the business is no more, right? Maybe we're not going to run it into the ground, but we're going to run it and we're not going to invest in it until there's a point in time when we can just close up shop cleanly. On the flip side, we're going to run it until a point where we can find a buyer because the market is at that time. And so during that time, though, between now and when you have that exit strategy, I want you to keep that in mind as we go through the rest of the presentation, because all the other items that we'll talk about today will help explain why having that exit strategy is important. So the first one being is investing outside of your business. And what we'd like to do is talk a little bit about after the year end comes, and depending on how you structure your business, you may sit down at the round table here and have a discussion, look over your financials. What are you doing with the cash flow that your business is providing you? And at the end of the day, if your business is a lifestyle, that's one thing. But if your business is a lifestyle that provides you with excess capital outside of what you need to run that business, you're in a really great position where you can leverage that capital outside of investing in the business to other investments and things that you can either have that it would be fun or things that you're passionate about. And so what we'd like to do is just touch on those a little bit, because if you have that excess cash flow, right? If you have a majority of your equity tied up in your business, what's your backup plan before that exit strategy is deployed, right? And so are you investing outside of your business in real estate? Are you investing in other ventures? Are you investing in the market? And then what does that investing cost you? It's not just an opportunity cost in terms of a financial opportunity cost that you might miss, but what is that time going to cost you? If you're a very active person in your business on the day-to-day, do you want to be active in another investment? Do you want to be in the middle of a meeting or a negotiation with a vendor or dealing with a customer, and you have to then take a step away from your day-to-day business to deal with an issue from another investment? And so these are questions that you want to start asking yourself. And so I would encourage anybody in the audience to chime in. And what do your relatively passive versus active outside investments look like? Do you manage your own stock portfolio? Do you have a group of real estate rentals that you run? How does that balance look for you? And is it something that you feel is manageable, or do you feel like it's more of something that deters you from being more productive in the business that you have yourself?
I did have a question here. How common is it for business owners to only have invested in their business and not have outside investments?
I would say surprisingly, it's pretty common, and sometimes that just boils down to time. It's really more about trying to figure out what's best for you. And what I mean by that is, we have a number of clients where we've had conversations with them where a majority of their equity is tied up in their business, and they are really good at what they do. But any investments that they've made outside of their business, they're really skeptical about, because they don't want to get pulled away from the day-to-day of their business. And so, let's just take owning real estate as an example, right? If I was to go out as a business owner and then buy maybe a 6 flat of apartments that I am now managing, well, if I'm a day-to-day person that bills by the hour, and I have made this passive investment, and now I'm getting calls from my tenants that says the toilet doesn't work, the lights are out, and I don't have somebody has a vested interest in helping me out with that, now I'm substituting the time from one investment into the other. And so to answer that question, we've found that people are skeptical, and they have this not a passive mindset, but more so a it's a lack thereof mindset, that there aren't other opportunities out there. You want to come to this from an abundance mindset, that there are an abundance of good opportunities out there that could be safe, that could be rewarding, that might not necessarily give you the same returns that you're getting from your business, but it gives you the opportunity to diversify. In the same instance, if you own a business and you have a small stock portfolio, if you don't feel like your advisor is in your corner, and you don't feel like they're doing the best for you, whether they are a fiduciary or they're not, now you're taking time to manage what you've hired somebody to do. And so then the question becomes, do you take over the account yourself? Who's looking at that account during business hours when trading is open? Are you going to now run your business and trade? It's now no different of a passive investment than that real estate investment you made, where now you're the one calling the plumber, or you're the one calling the electrician because your tenant has an issue, or your tenant hasn't paid you rent. So, what we find is a lot of clients or potential clients or people in our circle, they're just so heavily invested in the one thing that they do well, that it's really hard to peel them away to consider that there are alternatives outside of that. And oftentimes they've built this business up, but because they haven't been doing some of these outside investments, now they're playing catch up. It's no different than getting to a point where your business is cash flow positive, but now you're playing catch up with your retirement contributions because you haven't made those early on. And so that brings us to a nice next point with retirement. Retirement is a great tool for a small business owner. There's a lot of different tax-friendly strategies that you can use and accounts. I'm not going to talk about those today, partly because those are really widely available. But like that exit strategy for your business, legally, there's a time limit here that you have to reach before you can actually tap into those funds. And so the question that you have to ask yourself between now and retirement is, hey, let's say I contribute the maximum amount. I'm a business owner. My business does really well. It spins off a lot of cash every year. I have this great lifestyle. Well, is what I'm putting into my retirement account going to fund my lifestyle based off of what me and my spouse or my family are looking for? And oftentimes what we've found is it doesn't. We've made notes recently that Social Security is getting a little bit of a bump this year, and certain types of welfare benefits are increasing. But I would encourage you to look at those numbers and really ask yourself, is an extra $2,000 or $2,500 or $3,000 a month really going to make or break the difference between where you're living now as a business owner and where you'd like to live in retirement? And so let's talk about bridging that gap a little bit and talk about some of the things that we can do between now and then, like what we would do between now and the exit strategy of our business, that we can use to continue to build wealth and build financial independence, so that we might be able to retire earlier. We might be able to start another business sooner. Anything that you would like to do, chances are, if you want to do it sooner than later, you can't rely on that exit strategy. You can't rely on that retirement. So that being said, you as the business owner, you understand the risk and the rewards that are in front of you, right? You might have an exit strategy, you might not. You might have a retirement account, you might not. And so you have risked your time and your capital to not only invest in yourself, but invest in this idea, in this entity that you believe is going to do more for yourself and more for others by being independent. And with those risks come a lot of rewards. And so before we get into those rewards, let's talk about some of those risks, because like investing in the markets or in real estate, investing in your own business, you have this really great understanding of risk. And you understand that a perceived risk is a lot different than the actual risk. When you started your business, if you put together a business plan, you went over your SWOT analysis, you went over a market analysis, you not only went over all of the great things that could come of this business, but you probably identified some weaknesses, some things that you'd have to look out for. And on the face of it, you might be able to, proverbially go into the Shark Tank and talk about your business and your financials and the great things that you're going to do. But the difficulty comes is when you start asking yourself those hard questions. What happens if I run out of capital? What happens if my product doesn't sell as much as I need it to sell? What happens if there's an economic downturn in the time that I am needing to be launching? What happens if the business that I'm proposing, the legal and regulatory requirements are much more complicated than I thought? These are all of these risks that you may perceive to be different, but in actuality are exactly as you planned, or they're exactly the opposite. And so that's the same mindset that you want to have when you're investing between now and retirement. Ask yourself those questions that you want to get answers to that might not be the right questions to ask before you went through this presentation. And what I mean by that is, it's really easy to say, I have X number of free cash or X number of free dollars coming out of my business at the end of every year. I'm just going to make a conscious, effort to invest those in the market or invest those in real estate and try to, have that outsource. Have that conversation with yourself about what those risks are and treat it no different than you would treating and investing in your business. Understand the difference between perceived risk and real risk. And you'll start to understand not only your comfort zone with these outside investments, but also how passive they really can be. Because chances are, as a business owner, you're pretty hands-on. And you don't want to be put in a position where you're in a passive investment that now consumes you because you didn't look at those passive investments with that risk tolerance that you want. So, and then just, going into detail a little bit on some of those businesses or some of those ideas. Hobby businesses are something that's not often talked about. And what I mean by hobby businesses is, if you have a hobby outside of your work, that's something that you can actually leverage cash into. Oftentimes, that might be a taxable benefit to you. I'm going to leave that to your tax advisor to discuss. But oftentimes there are business opportunities that can be fun that you can invest in that might require a pretty good upfront cash flow that maybe you couldn't do when you first started your initial business. But it's something that you can put effort and time into that will eventually grow and become its own fun activity that you look forward to working with. And no different than if you are like me and you actually enjoy trading in the market. For me, trading in the market is like a hobby business. It's my business, but for me, I derive a lot of fun and amusement from being in the markets. In some respects, other people enjoy horse racing, real estate development. They may want to open up a franchise of some sort, whether it's an ice cream stand or something. There's always these little opportunities that pop up that you can actually have a lot of fun with as well. The really easy ones that are straightforward would be commercial and residential real estate. You're either buying a property that has existing cash flow, or you're developing a property that will have future cash flow. The key line here is if you want this to be a truly passive investment, you have to consider paying for a professional management. In no difference than for financial investing, if you would hire an advisor to look over your portfolio. Yes, you want somebody that you can fire. You want somebody that you have a business relationship with. It's a lot like your bank, right? I want to go into the bank. I want to give them some numbers. I want to qualify for the loan. A personal relationship is great in this sense, but if the bank doesn't perform, I have the right to leave, right? Same thing with real estate, same thing with investing. If you want this to be something passive, you have to have trust in somebody that can take over and handle a lot of these little day-to-day issues for you. And you can build that into your pro forma, and you can start to plan what the potential cash flow will be coming out of that business as you grow and as time goes on. Other active investing opportunities could include starting another business. It could include doing something completely different outside of your industry. Like I mentioned before, whether it's a franchise or a hobby business, but also maybe actively investing in the markets is something that you take pride in. And if that's the case, like I said before, just be aware that that may take time away from your business, depending on the hours and the time that you're committing to either. So that being said, investing outside of these little opportunities, some opportunities that might be a little bit more risky, but pertain to certainly higher net worth investors would be like private equity, investing in the derivatives market, or hedge funds. What you want to consider is, as a business owner, if you have a certain amount of capital, if you have a certain net worth, there are opportunities out there for you to be a passive investor in a lot of these name brand household firms that you would often think of as maybe being exclusive to ultra high net worth individuals, or perhaps family offices or institutional investors like pension funds or insurance companies. And that's just not true. What we've seen in the marketplace is there has been a shift, not only in regulation, but also in these firms that do have these quote unquote high finance offerings, shifting those perspectives to individual investors. And so while there are more risks inherent in these vehicles, some of them may not be as liquid as your current investments. These are very sophisticated strategies that you can lean on if you feel like they align with your goals. So hedge funds, private equity, certain real estate private equity firms are looking at what's called an accredited investor as a good source of capital, which is great for you as an accredited investor, because if you meet any of these criteria, you have the opportunity to jump into some of these things. And just going based off of the very black and white SEC's definition, if you have an earned income that's exceeded $200,000 in the past 2 years, and you reasonably expect the same, $300,000 for a spouse or a spousal equivalent, or you have a net worth of over $1 million, and that excludes your primary residence. Now, net worth would be your assets minus any liabilities that you owe. Or if you're actually in the investment profession, you could qualify as an accredited investor to meet the criteria needed for some of these investments. And most of these investments would involve a professional management team. You would have some type of portfolio or investment manager that would be handling these investments. They would have a track record. It would be somebody that you could actually go to and that would actually lay out what they foresee the investment to look like. And so anybody on this call, if you are thinking about outside investments that are passive, that could have the opportunity to look elsewhere than something that you would be in charge of managing, this is a great source. And it's just a good conversation to have when you're starting into this sphere, because it's a great way to leverage those passive opportunities that traditionally most individuals have looked at as being out of reach.
So here's a question about having, if you're an accredited investor, do you have to fill out some sort of certificate, or is there some sort of credential you have to get?
So each firm will have its own process, but it is pretty standardized that they will ask you usually for proof that you are an accredited investor. And again, it all depends on the firm that you're with. They will probably put you through some type of check that would be akin to like an anti-money laundering check, know your client. Something similar to a bank would be when you're opening an account. But at the end of the day, the onus is on the accredited investor to prove that they have the capital. And this is, I'm going to be very clear with this, that they have the capital to lose. So what the SEC and what the federal government looks for is they just want to make sure that if you're stating that you're an accredited investor, chances are you're a more sophisticated investor than a traditional real estate investor, which means that you not only understand the risks that come with some of these funds and some of these opportunities, but you also understand that this money you could lose. And so each firm might have their different processes and procedures. One might ask you for your tax returns or a bank statement from the bank saying that you have this net worth. Others may have some type of background check with a form filing done. It all depends. But at the end of the day, you just have to understand as the investor that much like investing in the stock market in January, if you're not comfortable with where we are today in October, with the amount of money that you've either made or lost, it's probably not the right opportunity for you. And so this goes back to the conversation about passive versus active investments outside of your business. I can tell you from experience that in a family business I used to help with, I would be every 2 weeks we had payroll, and I would always be worried because we were a startup company that we weren't going to make payroll that Friday. And it wasn't that we didn't have the capital. It just worried me. It just worried me that we had a commitment to our employees to make payroll. And these are people that had been with this family for, some of them had been with the family for 30 years. And so this was as much their lifestyle as it was as families. And in the same sense, if you are very personally invested in your business and you lose sleep over that, if you are able to detach yourself as an accredited investor or as an investor in real estate or an investor in the markets, it's a very different emotional perspective. And that's a really good place to be. But chances are, if you are more of an emotionally charged business owner, it may be difficult for you to not only make that investment, but also come to terms with the fact that you've lost that investment. So that being said, a little bit in the weeds there, but each fund, each firm is going to have different requirements. You just want to make sure that you can not only prove and substantiate that, but you actually want to make sure that it's true. So if you are an accredited investor and you believe that you're an accredited investor, make sure that you are an accredited investor, I think is the bottom line, right? Like, you don't want to come out of the gate and find out after the fact that, well, you really had made $190,000 a year for the last 2 years. Now you've put yourself in an awkward position. And, I don't want to go down the path of the, legislative or legal responsibilities that come from that. But, you owe it to yourself as the investor to make sure that A, you qualify, whatever those requirements are, and B, that you're comfortable with that investment risk, right? What's that perceived risk versus that actual risk? So
We have another question here, and it would be, is there a percentage about how much you can invest based on your income or based on your net worth?
No, not to my knowledge. What I would say to that is if you are married or if you have a significant other, make sure that whatever you're committing is not, well over your threshold as a couple or a family unit. But that being said, lean on an advisor or a family friend or someone that has been in this space before. Being an accredited investor is a unique opportunity, right? It's not hard to look at hedge funds and look at private equity as this kind of golden opportunity to seize these maybe perhaps outsized returns. But you don't want to throw all your eggs in one basket either. So ask yourself the right question and say, hey, am I better off allocating just a little bit of my pie chart? Am I better off throwing the whole thing in? And, a lot of times this comes down to your risk profile. As long as you meet the criteria of the accredited investor, there are no really limitations as to what you can invest. So just as a couple of action items here, what I would encourage anybody to do is if they have any questions about either derivatives, options, market opportunities that are a little bit outside of their purview, talk to an advisor that specializes with those things. What we've found over time is that the traditional financial advisor, only about 3% of them deal with options and derivatives. And part of the reason for that from a wealth management perspective is these are more risky assets. Marche and I did a talk recently about hedging your portfolio in uncertain times. And what a lot of it comes down to is, again, not only perceived risk versus actualized risk, but experience. If you have experience in something, or if your advisor can explain something to you in a manner that you can understand it, you want to be able to then explain it to your significant other or your child or something in a manner that they can digest it. And I would encourage anybody, not only that's talking with an advisor, but to think of investing like that. It's really easy to talk about real estate, right? I'm buying a piece of property, I'm renting it to a tenant is paying me rent. When you get to some of these more complicated instruments, it's really hard from a risk perspective to understand what you've gotten yourself into if you can't explain it to somebody else. And so if you have your portfolio analyzed and you feel like it's an appropriate opportunity for you to seek an opportunity for an accredited investor, or look at something that's a little bit more risky, but the risk reward profile is a little bit higher, make sure that you can understand it yourself. And so I believe with that, I can turn it over to any questions, any last minute talking
Yeah.
points or anything with any of our viewers today.
Yeah. So can you give an example of each type of, maybe just give an example of what an option is, and give an example of what, a hedging type of thing is, if just so that our participants know what kind of investing strategies you're talking about.
Sure. So a hedging model in its simplest form, and yes, the hedge fund, the name hedge fund comes from hedging, at least originally. It's since deviated from that, at least the industry has. Options are a derivative security, which means their price is based off of an underlying price of another security. And so let's take Apple as an example, real simple. Whatever Apple is trading at today, let's say it's $150. I can buy an option to buy Apple for $160 in 3 months. Now, I am paying for a contract that gives me the right, but not the obligation to purchase the underlying security. So this is different than futures contracts. So futures contracts are an obligation to buy. They are much more risky because of that obligation, but in many instances, they can be much more rewarding, but higher risk, higher reward. If Apple goes to 165, for example, in those 3 months, I can purchase Apple at 160 and I've immediately secured that $5 gain. If Apple drops, right, below 150, I don't have to exercise that option. So in essence, I've saved myself a little bit of money because I didn't buy Apple at 150 and lose that money, but I've also risked some capital to wager a bet on Apple going up. And so the thing about options, which is really unique, is you can do the flip side of that, right? I can buy an option to sell Apple at 150. So if Apple falls to say 135, I can exercise that option, or I could sell it to somebody else who wants to exercise it and secure in that maybe $15 premium difference. And what I'd like to be really clear about that with options is that these are highly leveraged and they're time weighted. So as time goes on, there's an expiration date, but also each option represents 100 shares of the underlying security. So if I buy one option of Apple, I'm buying the right to buy or sell 100 shares of Apple. So it's a unique opportunity. It's a unique financial structure. But the thing that is really important to understand is this is something that expires. At the end of the day, it has no intrinsic value. It does not represent a share of Apple or 100 shares of Apple. It represents the right to buy or sell 100 shares of Apple. So if you have a theory as an investor that a stock or an equity or a indice is going to go up or down a certain direction in a wait of time, in a period of time, options could be a very powerful tool. What you don't want to do is just waylay a bunch of options out there and buy or sell them without understanding the risk profile with no thesis, right? Nobody goes to the scientific community without following their hypothesis, their testing, their proof, their data and everything. Options are really, really, really nuanced in that manner. You don't want to do that, because you can, if I buy a share of Apple at 150 and it goes up, down, whatever, I still own that share of Apple. If I buy an option and it expires in 3 months, I have nothing. So with that, I wanted to address one comment in the chat here. And Marcia, do you want to read it, or should I?
Yeah,
Okay.
I'd be happy to. So this particular individual says they own an S Corp, so they're not an accredited investor yet. Hopefully, we can say yet. However, what type of retirement options are available to small business owners who may not, be looking to do things in the derivatives market?
Right. So I would certainly say that for a small business owner, there are some really simple, and they are simple individual retirement accounts that you can either set up for your employees and yourself, that you can contribute to out of your payroll, and that your employer, which would be you in this case, could also contribute to. Depending on how you've set yourself up, in many instances, S Corp owners are salaried employees as well. You can contribute a certain amount of your payroll off to that new retirement account. There are some accounts, depending on how much your payroll is, where you can actually really exceed the normal contribution amounts. And that would be something that I'm happy to get into at a maybe a separate time. It's just very nuanced because it's adjusted for inflation and the like. It all depends on, at the end of the day, in my opinion, how much income you're looking to push off for retirement, and whether you're looking to just hit that contribution limit, or whether you're looking to maybe exceed that and put more away for retirement. And so, that being said, you might qualify for multiple different accounts, and you can start pulling that away into those accounts. I would just be mindful as a small business owner, if you do need capital later on, and maybe a year or two down the line, once you've contributed that capital, if it's pre-tax, you may be penalizing yourself if you need to pull it out later. So there are some options available. It depends on how many employees you have, what your current payroll draw is. But in many instances, you can, as a business owner, you can sock away a pretty good amount depending on that account type.
All right, I hope that answered that question. If not, go ahead and comment in the chat again. We'll try to circle back to that if we have time. All right, so you talked a lot about passive investing, although it sounds like some of these passive investment options aren't so passive. For example, the real estate example. How much involvement would it be to invest in these alternatives?
I'm sorry, Marcia, how much time?
How much time, would it take for a typical investor, accredited investor?
Well, let's say accredited investor, unaccredited investor, in any investment opportunity, the most important piece of the puzzle is the pre-investment piece. Whether you're investing in real estate and you're buying a small apartment building, or maybe just one single family home to rent out, whether you're investing last year's bonus into the stock market, or you're making a big investment as an accredited investor into a hedge fund or a private equity fund, your due diligence period is crucial. That's the opportunity, and that's the time that you want to spend. And you want to be cognizant of the expectations on the back end. If you're investing in the market will always be there. You may not, quote unquote, time the market the way that you want, but the market will always be there ready to take your money, so to speak. If you're looking at real estate and you have your eye on a particular piece of property, it might behoove you to put on an offer sooner rather than later. If you're in an investment that's an open-ended fund, meaning you can invest at any time, might give you some more opportunity to do some more due diligence. If you're in a closed fund, which has a date where they need to have that capital, like a capital call, that means you only have a certain amount of time to do due diligence. And what's important about that is I would say the more time, the better, just being cognizant of that opportunity. And there's really no, from an advisor's perspective, I would never want to rush anything. So if you're ever being rushed, or in your position where you're being sped down the line, if you don't feel comfortable having done all the due diligence necessary, don't make that investment, right? don't feel pressured to make that investment. First of all, make sure that the investment is legitimate. If it needs to be licensed, make sure it's licensed. If it's something that's in finance, make sure that it is got its proper registrations. If it's something in real estate, make sure that the property actually exists. You want to make sure that you're taking enough time to make sure that this investment will meet your goals. And the reason that I stress due diligence is if you are truly looking for a passive investment, things that are passive that become an active investment very quickly are ones where the issues that would pop up during due diligence pop up well after or immediately after the close of a transaction. So you don't want to buy, if you're looking to buy a passive piece of real estate, maybe you want to buy a passive piece of real estate that has a tenant in place. You don't want to go in and buy a rental home that then you have to figure out how to rent, as an example. You don't want to buy a rental home that needs a new roof or that needs a new water heater or that the water heater exploded and hasn't been fixed yet. I mean, I can give you a litany of issues, but don't rush yourself in any of these investments. And that stands for market investments as well. And for the panelists, or excuse me, for the participant that asked that question, whatever retirement options are available for you, spend some time getting to know which accounts are available for you and why they meet your and possibly your employees' best interests. Some might have more advantages that are better because they're pre-tax. Some might have more advantages because they're better because of their post-tax. Depending on your income, you may be exempt, or you may not be allowed to contribute to certain types of accounts. In the United States, some pre-tax accounts are limited in their contributions. Some post-tax accounts are limited in their contributions. And so the questions that you want to ask yourself are, what options are available to me and why? An IRA might be a great opportunity for you as an individual investor because you have a little bit of more control, whereas a 401k is more of a structured plan. And while it's structured, it may be limiting in the investment opportunities that are available to you. So, I guess my last little blurb here for anybody would be, don't be rushed. And if you feel like you're being rushed in any investment, I would be skeptical. The last thing you want to do is make an investment and realize that it wasn't the right investment for you, or maybe even the worst case scenario, it wasn't even an investment. It was maybe something more fraudulent. So I would be very mindful of time.
Well, I want to thank our attendees for being here. That's about all the time we have for our webinar today. On behalf of Advice Chaser, we want to thank our speaker and the organizations that have worked with us to bring you this webinar today. And thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.